I haven't seen in 18 years of my career any single HNI or any single fund or any single investor making significant money, forget about significant money, little money also, by doing day trading.
Niket Shah is India's youngest chief investment officer at Motilal Oswal Asset Management. He has over 15 years of expertise in equity research and portfolio management.
Are there any macroeconomic indicators that one needs to monitor?
I think the simple number that you should track is GST collection. People tend to sell their winners earlier and tend to hold their losers for a longer period of time. Just avoid noise. We don't have television in our offices, by the way. For most of the time, we have no idea what is happening outside. If there is a war, we will come to know after 3:30. I think taxation really needs to reduce. That if tomorrow markets are to come down, 18 crore investors will get impacted.
There are a lot of sectors that will be a lot more vulnerable to macroeconomic fluctuations and changes. Which are those sectors? Right, so thanks so much for joining in. I think, when the average person puts on the TV and you see those big headlines about India surpassing China when it comes to being an investable market, the GDP growth print, inflation at all-time highs, I just want to understand from you what it means for the common man when we read all of these macroeconomic headlines.
So I think, there is a lot of noise around the world at all points of time. One really needs to ensure that you don't get carried away by those noises. For example, geopolitical. You would have seen multiple wars happening, Russia, Ukraine, Israel. But if you look at markets, where US markets are, when Indian markets were a few months back, they were at lifetime highs. Because when two smaller geographies get into a war, it doesn't have meaningful impact on supply chain. But if the larger geography gets into a war, there will be. So there is a lot of these noises that we see on a regular basis, and we do recommend, in fact, we internally don't follow some of these. But I think there are some things which are quite important, which is inflation, because it has an impact on interest rate cycle and hence impact on a lot of sectors in terms of the performance. So that's quite important. How things will change once Trump really comes into power, I think that's very, very critical. We do expect this time there will be a lot of announcements on the tariff side, but more than that, I think we do expect a lot of changes on the fiscal side that the government will do, and that can have meaningful ramification across the world, including the United States. So I think some of those things which are quite less talked about is something that we generally focus a lot more on.
So let's take inflation from that. It's widely talked about, and why not? Because it can impact the purchasing power, drop in savings. What is the impact for you and me when we read those inflation numbers on the screen?
So I think one is, inflation has been quite stickier in India, specifically on food inflation. In fact, yesterday data did suggest that food inflation is up 9%.
But it has cooled off a bit.
It has cooled off, but I think it does cool off, right? Because there's base effect which catches up on every month-on-month basis. But it's still quite punchier. And I think till that extent, what will happen is that the normal consumption side, you look at the FMCG basket as such, most of the FMCG companies are unable to see meaningful volume growth because of the inflationary environment that we continue to see. So it does have impact on the economy, on the consumption side. Having said that, I think it does benefit the banks, because what happens is when there's inflation, RBI will hike repo rates, because more than 40 to 50% of the bank's AUM is linked to repo. They immediately see yield revision and hence NIM expansion.
Okay, wait. Let's break this down in simple man's language. We read the inflation print and that's looking high. Food prices are going up, tomatoes, onions, all of that is becoming more expensive. How does that impact me with respect to what the Reserve Bank is doing? If you could just, simplify.
So I think one is, Reserve Bank has a lot of options. One is the simplest option is to increase interest rates.
Okay, so what does that mean? If you could just explain.
If you look at a large part of home loans in India, or personal loans, or any category where a customer has a leverage, typically when the interest rate moves up, he will have meaningful reduction in cash flows, right, on an immediate basis. To that extent, his purchasing power or his intensity to spend in the economy reduces meaningfully. And if the rate of increase in interest rates is much higher that we saw in the last 2-3 years, we've actually seen more than 170, 180 basis points increase in repo, and to that extent, similar amount of increase in interest rates, then the customer does feel that pinch. The second thing that you also have to keep in mind is that obviously when interest rates are increasing by the Reserve Bank, it does slower the economy, which means that the salary growth that we generally see also is lower. So hence it kind of impacts the spending in the economy from a consumer standpoint. And I think these are cycles, right? And effectively when there is slowdown, the inflation slows down again, RBI cuts rates again, and focuses back on growth. So it's like a virtuous cycle.
Right. And then when it comes to our investments, for example, someone who's investing in the classic mutual funds, inflation being higher means that now mutual funds will have higher operating costs, right? So how does it impact one's, and then also the portfolio, you can see the impact on equities. How does one's portfolio, I want to understand, get impacted?
So I think portfolios also will tend to get impacted because if the economy is slowing down because of higher interest rates, that means lower earnings growth. Right? And when there's lower earnings growth, it means that markets are not going to do well in the near term. We did see in the first half of this year, earnings growth is not more than 3-4% for Nifty companies. And to that extent, we're seeing a market getting consolidated completely. So then it becomes, from a portfolio manager standpoint, one has to be extremely stock specific or a theme specific. And one has to make the portfolio much more sharper. You can't have a portfolio of 150 stocks when the economy is slowing around, because the entire market will become much more polarized. We've seen 2010 to 2020, only a few sectors did quite well because the economy was not firing all cylinders. So when the economy is not firing all cylinders, you will see market being much more narrower. And when in the last 4 years you saw economy firing up all cylinders, you look at the breadth of the markets, very wide. You saw sectors like defense and rail flourishing, which no one would have thought in 2020 they would. So the market becomes much more broader when the economy is doing quite well, and narrower when the economy doesn't do well.
Right. I want to talk about making your portfolio sharper, etc., a little bit later. But then we read also things about the GDP growth and how do you think an investor can align their investment philosophy to ride the momentum that we're talking about, the strong growth momentum in India?
So I think one also, obviously the GDP print has not been encouraging, and it's also reflective of the fact that earnings growth weren't encouraging. So earnings growth was a lead indicator and GDP is a lag indicator. Again, I would like to highlight that one should not get carried away by a lower GDP growth number thinking that India is not doing well. I think you will see some of those aberrations in an election year. So you have to keep that in mind. Having said that, yes, we did see slowdown in the economy in multiple areas of late. But I think if you take a 3 to 5 year view, things aren't so bad. We are seeing a lot of government policies in the right direction. Let me give you a small data point. If you look at US today, they have 3% of the world's population, but they contribute to 25% of world's GDP. Europe has 5% of the world's population, contributes to 18% of the world's GDP. China has 17% of the world population, contributes to 17% of the GDP. But India has 18% of the world's population, contributes only 3% of the world's GDP. Why? So we really need to snatch this, or we really need to make this happen, which is what government has been up to when they're launching some of these PLI schemes. They are up to this, and the only way you can get it larger is by doing exports. Right? Otherwise, you can't become larger.
And that'll help us for sure.
That should help us in a meaningful fashion.
So as an investor, are there any macroeconomic indicators that one needs to monitor when it comes to their investment philosophy or aligning the portfolio?
I would say that from a layman language, I think the simple number that you should track is GST collection.
Okay.
So if the GST is a reflection of, and so as lead indicator as it gets, right? So the GST data is weaker, for sure. There's challenges in the economy as such. That's the simplest one. But we do track a lot of data. We do track power demand, electricity growth in the economy, e-way bills growth, and a lot of there are a lot of indicators that we get on a regular basis. Something that we track. But I think for a layman, I think GST collection is a good number.
Fair enough. So when I see that alarming number or that drop in the GST collections, I want to say there's going to be now a hit to my portfolio, right? How does a typical investor mitigate that risk to the portfolio?
So I think one important mitigation risk is diversification. Don't have all eggs in small cap or don't have all eggs in large cap, either side. Have a very balanced portfolio, which is a mix of large, small, and mid, which is quite important because you will see cycles playing out at all points of time. And for a layman, it's quite difficult to time that cycle, when mid will do quite well, when small will do quite well. So it's a very important part to have a very, very balanced portfolio, which will really help you to mitigate any shocks that you see in the system. So whenever there's a negative environment of GDP growth or a lower earnings growth environment, large caps will fall far lesser as compared to mid and small and vice versa.
And of course, you said not putting all your eggs in one basket. And then you earlier spoke about sharpening your portfolio.
Sure.
So do you reevaluate at a time when there is a possibility of your portfolio dropping, or do you do it well in advance? What would be key?
So the way we look at risk mitigation within our AMC is that we look at individual companies when we buy them. If they underperform 15% or more to the index, we go and revisit those assumptions.
Okay.
There has to be some threshold where you really need to start to act. It can't be like a open up kind of a situation where you just don't know when to act, or when the markets will fall, you'll start acting.
Yeah.
So by virtue, what happens is within our AMC, if a particular stock is underperforming more than 15% to the index, you're not allowed to buy more.
Okay.
So you don't put good money to bad use. Let it outperform and then you come back, right? Or you revisit your assumptions and then you come back. So we make it into a freeze list that you can't allow to buy because it's underperforming the index.
Okay.
And when it starts to outperform again, you actually can go and buy it again. That really helps you to ensure that your allocation on companies which are doing very well always continues to keep rising. Because I have 100 rupees that the investor gives me, I have to invest that. I can't keep 100 rupees in cash.
Yes.
So I have to invest. So if I have underperforming stocks which are in freeze list, by design, all those money will go towards the high performing stocks.
So apart from weeding out the underperformers, can you tell us a little bit more about your strategy, about how it differentiates you from the other players?
So we do, so in the last 4 years, our philosophy of QGLP is extremely well articulated by Ramdev Agarwal. So we do follow QGLP, which is buying extremely high quality business with high quality promoters. G stands for growth, which is buying at least companies with more than 20% earnings growth. L stands for longevity of the growth. We don't want growth for a quarter or two. We want at least for 3 to 4 year period. And P stands for price. You buy it at the right price. There are few differentiation that we've brought to that model in the last 4 years. The first differentiation that we brought is that we told everyone in the team that you have to be ahead of the curve. You can't expect a company to report great results and the next day when the stock opens up 10%, you go and buy. That will not give you significant alpha generation over a period of time. You have to predict that. And there are enough and more lead indicators across individual sectors which are available in public domain for investors to go and have a look, and then they make their position. So a lot of people don't tend to have that courage. Yeah. So what we internally say is that you should have vision to see, courage to buy, and patience to hold. So that vision to see is quite important, that this particular theme or sector is not going to do well. For example, IT this year, we have been massively bullish on IT this year. 2 quarters back, we could clearly see cloud revenues were bottoming out for large US enterprises. And we could clearly make that in the next 2 quarters, India will see that rub-off effect starting. And we actually bought meaningful ITs, largely in mid-cap space. And that has done extremely well for us. Now, if you wait for a good quarter results to come and buy it, you might be buying 25 to 30% higher than what I bought it. So that's the first thing. Second, I think, is in India, everyone talks about buying, but no one talks about selling. Right? People tend to sell their winners earlier and tend to hold their losers for a longer period of time. We just do the other way around. Right? We are probably phenomenal buyers in the past because of our ideation that we bring on table. But we have also been extremely good sellers in the last 3-4 years. Wherever we saw stocks have done extremely well, valuations are extremely rich, we have taken money off the table and moved to a category or theme where there is more upside to be taken as compared to the earlier one. So that, I think, is a second major change that we bring on table. Third is that, which is quite important, is that we don't focus when we buy that who is the other guy who's buying with us. Whether it is blocks or it's, typically in India, you see a large HNI or a large fund buying, and if you see that reporting in a block deal, there is by design people chasing that same stock. So we don't want to be dependent on borrowed knowledge. We want to have our own analysis done. And in most of the cases, we have seen that wherever we have our own team being bullish on it, we've gone for it, where there's virtually no investor in that particular stock, and we've made 10 to 20x return in that stock.
Okay.
So I think that's quite important, to have your own independent mindset and own independent thought process. Do your detailed work and go for it. Don't think that this guy is seller or that guy is buyer. It really doesn't work in the longer term.
No, it's important, and I will come to the temperament and the behavioral aspect of it. But I'm sure there are a lot of sectors that will be a lot more vulnerable to macroeconomic fluctuations and changes. Which are those sectors?
I think the biggest one is banks, because one is obviously when there is inflation environment, RBI will tinker rates. But on the same time, there is asset quality movement. When the environment is quite good, asset quality is brilliant, and vice versa. So banks is the most cyclical sector and kind of gets reacted to every, if you look at COVID, right, the biggest sector impacted was banks.
Yeah.
So I think banks,
every time there's RBI policy also, it's
the banks, right? So bank is at the center of the whole action, I would say. Then second, I think I would expect some of the consumption side to clearly get impacted. If the environment is quite well, we do see very strong consumption pickup and vice versa. So I think these are the two major sectors that we generally think. Now, from a global standpoint, if anything goes wrong globally, I think we do see metals and commodities and IT impacting to that extent.
Okay. So which are some of the themes that you believe are looking promising? Consumption, for example, the numbers were clearly disappointing and the slowdown is evident.
Right.
Is there going to be more pain in store for consumption?
So again, within consumption, it's very important to peel the onion. So if you look at some of the food delivery guys, they are reporting phenomenal growth in north of 60 to 70%. If you look at the jewelry sector, it's still growing at 30-35%. If you look at large value retailers, they're still growing at 40-50% on the apparel side. So there are enough and more green shoots in the economy, provided you have a very solid business model, right? Where are the things slowing down? If you look at FMCG, is clearly slowing down. Where a large part of the lower strata of Indian customer is clearly impacted because of inflation, right? So that is where there is meaningful impact. You look at real estate, right? Flats more than 10 crore grows at 20%. Flat less than 10 crore is flat. If you look at footwear, the luxury footwear, which is 1500 rupee SKU size plus, 1500 plus price point is growing at 30%, at least in the last 3 years. And the lower end of the strata, which is less than 1500 rupee price product, is actually going at only 4-5%. So the luxury market has done quite well in India, right? And we've seen that not only for footwear or not only for real estate, we've seen that for across categories.
Yeah, that premiumization trend.
Premiumization trend is really picked up. In fact, if you look in case of auto, a large amount of sales now come for top-end vehicle. No one wants to really go for the entry-level vehicle. So there is premiumization in the economy, but I think the real volatility is at the lower strata of the economy, where I think inflation is really hit hard.
Yeah, I mean, and that's what I want to come to for, going to that pocket and talking about that strata of society as well, the lower income groups. Won't the higher inflation, etc., impact them a lot more?
It does. And the reason why it impacts more is because historically, when RBI used to increase rate, banks never used to react to it or used to react with a lag. Now, RBI has linked repo to your yields. So what happens if RBI takes repo increase of say 100 basis points, next day your yield goes up by 100 basis points. So immediately your cash flow gets impacted, right? So that I think is a big change post-COVID that we have seen versus what we have seen in the past 25-30 years.
Now let's talk about the behavioral or the temperamental aspect of it. When we see these sort of headlines or when we see, for example, the stock markets going down, there's always that tend to hit the button, that sell button, etc. What should one do when it comes to temperament?
So I think one always, first at the heart, one should really believe in the longer term India story, right? Typically at times like, such high volatility that we generally tend to see, we do see people forgetting all the India story. People are only, focusing more on the P&L, right? Because they can't see meaningful amount of reduction in their profitability or, incremental increase in losses. Our view always has been that for those who don't have that temperament, please don't do leverage. Reduce leverage in the portfolio. Invest yourself if you feel like, but don't do leveraging. I haven't seen in 18 years of my career any single HNI or any single fund or any single investor making significant money, or forget about significant money, little money also, by doing day trading. The best of the investors you can take, including Rakesh Jindal, hasn't made money through doing day trading in life, right? The biggest wealth is created by only doing long-term investing. So if you really want to follow someone, look at the success stories in India. In most of the success stories, you will only find that you need to have at least a 2 to 3 year mindset to investing. If you have a 10-year mindset, nothing like it. But if from a starting standpoint, at least have a portfolio of say 25 to 30%, which is only dedicated to long-term investing, right? Balance 70%, you can continue to invest, but you should avoid day trading because there is no way you can make money on day trading, right? I haven't seen anyone who's been successful day trader, at least in India, yet
And
to
if
meet
the
one.
pros can't do it, you certainly can't do it,
Certainly
right?
can't do it.
Okay. What about announcements like the budget, for example? Next year we're going to have Modi 3.0 and there'll be a lot of emphasis on infrastructure, etc. But for the common man, how does it impact them in terms of better access to services, policies, income tax slabs, etc.? What should you and me watch out for?
Well, I think this budget is only about taxation. I think the government has clearly articulated they will make meaningful changes in taxation. And taxation in India is quite complex. On one hand, you have to pay higher taxes. On the other hand, you have to look out for those, exemptions that you have. And there are multiple lines of exemptions, right? So our sense is that the taxation should actually first be much more simplified. You should be given choices that you pay a lower tax, but then you don't get any exemption, for example. So I think taxation really needs to reduce. I think we've seen time and again that when you reduce taxes, the actual tax collection goes up meaningfully, right? And across duration, we have seen that data, not only with personal, but also with corporates. So there is a real need to reduce taxation, because once you reduce taxation, more number of people come into the tax bracket. The second is it leaves more money in the hands of the customer to go and spend in the economy again, which again stimulates the economy.
Okay, just if you could give us some examples or just draw out some data and talking about how on a broad level GDP or inflation or all of these indicators impacts the standard of living or the household disposable income on average?
So if you look at inflation, definitely has a meaningful impact for people who have income less than 50,000 rupees a month. It definitely hits them quite hard. If you look at GDP growth, again has a meaningful impact, because if the GDP growth is slowing down, obviously means that the earnings growth is slowing down across the economy, which includes the large corporates as well as SMEs in India. And to that extent, the salary growth or the income growths are also reduced, right, meaningfully. To that extent, the intensity of doing private capex in the economy also meaningfully comes down. So it is again a virtuous loop, and I do expect that GDP reduction as well as interest rates are to some extent interlinked, right?
Yes.
But I think you have to keep in mind that when inflation is quite higher, it will have meaningful impact to the customer's wallet. One also needs to keep in mind that if you look at the personal loan growth in the last 4 years has been quite strong, but you don't see that data in spending. It's not adding up, right? So we do expect a large part of the money is going to equity markets. And if people have lost large part of the money in equity markets, either through credit cards or either through personal loans, they have taken leverage in the system, which is quite dangerous for us. So that I think has become a third element now to worry for versus inflation and GDP. That if tomorrow markets have to come down, 18 crore investors will get impacted, right? Versus prior to 2020, it was only 4 crore investors. So 4 crore demat account versus 18 crore demat account, the impact will be much more severe if there is a meaningful drawdown in equity markets on the economy.
As a house, Motilal Oswal, which are the sectors that you believe look promising long term?
So I think we do look at themes actually, which can also transfer into sectors. We're quite excited about the manufacturing theme, and within manufacturing, electronic components, which I think there is likely to be a PLI shortly to be announced. So I think if you look at the total production of electronics manufactured by India since independence is $550 billion. And the government wants to make that as $500 billion on a yearly basis in 2030. Right? We are right now at about $120 billion. If you look at manufacturing for China, actually India and China in 1980s were at the same level of exports. And China really took a big leap from 2005 to 2015. Today, manufacturing as a percentage for China is about 35% in the best of the times. In the worst of the times, they're at about 25 to 28% range. India is only at 3%. So there's a huge runway of growth. Now, specifically to electronic components, right? If you look at the top 10 countries in the world, 9 of them are importers of electronics, right? So there is a buyer waiting for you, right? You don't have to search for a buyer. There's a buyer out there. It's just that you have to be a participant to that. And you have to, the PLIs that the government has been announcing on the mobile phone side is quite, going to help this acceleration to happen. If you look at most of the cases across the world, merchandise sales or merchandise exports, so we bifurcate export in 2 parts. One is IT services or services and merchandise. Merchandise is 80%, services is 20%. For India, merchandise is almost 45%. and services 55, you really need to dial up on merchandise.
Yeah.
You need to sell more stuff, become more competitive globally. Only then, you will really go up the ladder.
Okay.
Right?
Any other sectors?
So that's one. The second sector that we continue to like is the whole consumer discretionary space.
Okay.
India's per capita income is $2,500. China's at $13,000. US at $81,000. Even if you go from 2.5 to 5, a lot of these newer value migration themes, like the food delivery business, quick commerce business, jewelry category, will do extremely well. And I think we believe there's a significant runway of growth in some of these categories because penetration is still quite low. And these are businesses where we believe there will be 30 to 40% earnings growth, at least for the next 3 to 4 years.
Okay.
So that's the second thing that we continue to like. The third thing that we continue to like is IT. We do believe IT will make a huge comeback. I think AI is the second biggest innovation post-internet. And we haven't seen the full rollout of AI in a meaningful fashion. We have just seen some pilot
Tip
orders.
of the iceberg.
Yeah, so you should start seeing meaningful acceleration in AI starting next year. So that should augur quite well for a lot of the mid-cap IT names. So these are, I think, largely the three areas that we continue to focus on.
Okay. Given that you spoke about the banking sector being very vulnerable to macroeconomic changes, as a risk-averse investor, what profile of investor do you think should, if you're risk-averse, how much of an allocation should you have to the banking sector is what I want to understand.
Well, generally the way we think within the house is that if you're very confident that the sector is not going to have zero allocation. Why have
banks?
Yeah, we run a zero bank portfolio, right, for last 18 months.
Yeah.
The mindset in India is that banking allocation, so you look at index weight is at 30%.
Yeah.
Even if you're negative, you have 25. But even that 25 is going to underperform, right? So if you're confident that banks are not going to do well, or any sector for that matter, if you're confident it's not going to do well, then I think why have any meaningful allocation?
Okay. Let's shift away and from equities and wanted to understand what the impact of macroeconomics is on bond yields and investments in some of those instruments.
Sure. So I think if you look at, obviously inflation has a meaningful impact and interest rates environment has meaningful impact on bond yields.
Yeah.
Having said that, I think the foreign investment in bond yields in India or G-Secs in India is only 1.5%. So it's not pretty large. Having said that, I also believe that RBI has done a phenomenal job in the last 4 years to manage the rupee, to monitor the forex reserves that we have, which are pretty much a record high level, and the bond yields. So I think that's quite important. But from an investing standpoint, the bond yields movement only from a sectoral standpoint only benefits banks because they will have meaningful mark-to-market gains when the bond yields come off to that extent. But otherwise, I don't see any meaningful because in India people don't have large amount of allocation to debt.
Yes.
So any which ways investment itself is quite small, right? The penetration of equity is only 5 to 6% in India.
Yeah.
That also was only 2 to 3% a few years back.
Okay. You spoke about Trump, etc., and that's also going to be very important to monitor in the coming years. And then you've got the dollar index, which has only been gaining traction. The rupee was at an all-time low recently. Which sectors are susceptible to the movement of the currency?
Well, I think IT obviously benefits when the currency moves in the other direction and capital goods gets negatively impacted because of a large amount of import that we continue to do. So that's the simplest one. But I think from a Trump standpoint, I think India has a lot to gain. Let me give you an example. If you look at the recent tweet that he's done, where he's articulated that I will put a meaningful tariff on Mexico, Canada, and China. Now, if you look at Mexico's import or exports to US, the large part of export is wires and cables and auto anchors, but wires and cables. Now, that's a huge opportunity for Indian wires and cable companies, right? More than $6 billion worth of export happens from Mexico into United States. If that becomes expensive by 25%, there's a meaningful role that Indian wires and cable companies are going to play there. So there will be a lot of those smaller benefits which will be there for Indian companies to really take on. If you look at solar, right? If there's a 10% additional increase in duty on solar modules, Indian guys will get that benefit, right? Because it makes you more and more competitive by every passing day.
Okay. And how do macroeconomic factors like digitization, fintech growth, green energy transition, how does all of this impact or shape the mutual fund industry?
So I think mutual funds have been quite excited about some of these categories that you mentioned about. So I think the first one is obviously energy, transition. And if you look at in India, about 450 gigawatt of power capacity that we have, of that about 200 gigawatt is renewable, which includes wind, solar, nuclear, hydro, all of that put together. But the fastest one is solar. Now, solar businesses in India are actually growing at a rapid pace, right? From almost 65, 70 gigawatt is expected to go to 250 gigawatt in the next 4 years. There's significant focus across the world, not only by US or Europe, but also by India. Indian government is protecting their own companies, right, by putting duty structures on China, because there's significant amount of supply already ready in China versus the demand that we have today. So the government is playing a very pivotal role to ensure that the solar companies in India thrive and grow, at the same time making export quite lucrative, because US has also put a duty structure on China. So I think till the time this arbitrage is on, I think some of these companies in the solar space will do well. But the day that arbitrage goes away, the stocks will be down 70 to 80%. So it's kind of trading on thin ice. So hence when we look at that sector, we look at only companies who are focusing in India, right? Because it's quite difficult to take a risk on the international markets. Second, I think structurally all the Indian companies today were in the module space. They have to do backward integration. They have to go to cell, or have to go to wafer, have to go to ingot. So they have to become more and more competitive and have to do backward integration to make their business model much more stronger. If you're only doing module manufacturing, you're susceptible to meaningful risk. Because I think in next 18 months, across geographies, there will be meaningful amount of overcapacity in solar, including United States and India. And then again, you will see compression in margins playing out. So that is one thing that we continue to like.
You did stress upon the importance of having a nice diversified portfolio, but say for those investors who have only seen one sort of a movement play out in the market, and that has been one way, and they've put their money in a lot of small mid caps and those kind of funds, what is it that you would advise them to do?
Well, I would
and micro caps.
Yeah, so I would only advise is that first of all, if you get time, please analyze or read annual reports. Please look at P&L, balance sheet, and most importantly cash flows. I mean, for us, we start from cash flows and then go backward to P&L and balance sheet. If there's no cash flow, signs of worry for sure. Second is, I think, don't get carried away by the social media Twitters on SME stocks and all. I think they're extremely risky, right? So it can actually it can just wipe off the entire capital that you've got into in equity markets. Third is, I think, continue to focus on high growth, high quality businesses. Whether you do it through mutual fund or individual investor, I would suggest mutual fund, because it's quite easier for us to identify which is high quality, which is high growth, quality of management. So I would recommend most of these newer guys to at least have a meaningful amount of allocation in the mutual fund side, rather than trying out directly in some of the micro caps. Now, micro caps tend to do quite well when the economy is doing quite well. And they're the most vulnerable in any global shock that we tend to see. We have seen 2008 where stocks were down 80 to 90%, and you can virtually wipe off your net worth. So I would say that most of the newer generation or the newer guys who have got into the equity markets in the last 2-3 years, largely in below 35-year age category, needs to be quite cautious and not get carried away by the market, because we are seeing so much froth in the market right now on multiple sectors. People get so easily carried away by, say, semiconductor or CDMO space, without even thinking that what is going to happen in that space for the next 4 to 5 years. Right? Is there anything on the ground today to talk about? There's nothing on the ground to talk about. The first chip that India will manufacture will hopefully come in 2020 or 29.
Yeah.
Right, on ground. So why get excited today? Let it happen. Let it plan out. These are complex businesses, and there's no guarantee for success. That you will, if you're putting a chip manufacturing plant, you're definitely going to come out with a chip, right? So I think some of these, I would say narratives is something that one should be very, very careful about.
Okay. Speaking of no guarantees for success, although these are black swan events, they don't occur too often. The global financial crisis, for example, COVID, that really, turned things on their heels. What do you advise investors to do at times of a black swan event, temperament-wise also?
So I think whenever there's a black swan event, and history has been an example that's the best time to invest in Indian equity markets. While we don't pray for a black swan event, but when the black swan event comes, I think it's always a great opportunity for wealth creation. Imagine someone who was born in 2009 or someone who was born in COVID bottom has made tremendous wealth in the cycle. You just need one big cycle for you to make meaningful wealth creation. But again, the caveat is you have to invest for 3 to 5 years, and if possible 10 years, to really get that entire benefit of the cycle. And every country goes through that period, by the way. If you look at Japan, from 1980 to 1989, the Japanese investors made the most wealth that one could have ever imagined. The PE multiples in Japan went from 17 times to almost 75 times, right? And then the bubble broke in 1989, December 1989, and the Japan index came to that same level after 35 years. And the same happened in China from 2005 to 15. Big manufacturing cycle played out. Japan really took on exports in a meaningful fashion, and obviously fired the economy till Trump got in 2017 and again had an impact on Chinese economy. And then COVID obviously had some impact on China as well. So in case of India, this, in my opinion, is probably the best decade that India is facing, right? Which is 2020 to 2030. The government is doing all possible moves that is required to make India larger at global stage. If it doesn't happen now, I don't think it's going to happen ever. And I think there is significant amount of willingness when we meet bureaucrats or corporates. There is a significant sense of urgency that corporates tell us that they generally see from government, which is never at least seen since independence. So I would say that the next 10 years are for India, and hence any shock that you see because of any external factor, don't get perturbed about it. That is probably the best time to go and invest from a longer term standpoint.
Any top 3 behavioral advice that you would have at a time of a black swan event that you could say? Just pin it down to 3.
In case of black swan event?
Yeah.
Yeah. So I would say that in case of black swan event, the first behavioral advice is that you should avoid, the first thought process, you should avoid small cap. Okay. But for us, you should buy small cap because that's the most beaten down sector, right? Without compromising on quality, right? In a black swan event, greed should be far more higher. Okay. Right? You should think that I have to make significant returns in the next 3 to 5 years because I've already avoided that black swan event. And if I have some capital, I have to invest in high quality small caps and high quality mid caps. At that time, the large cap allocation should meaningfully come down, right? Because it's time to take higher risk in the economy. So that's the first point that I would recommend everyone with. Second is to avoid selling. Don't sell, just because you saw a meaningful drawdown on the portfolio and you just start, you can't take that meaningful hit in the P&L. So you should avoid throwing away those towels, generally what we say in a time like this. And the third thing, which I think I would also recommend a lot of people, in a black swan event is just avoid noise, right? We don't have television in our offices, by the way. We just don't have television. Okay. We have no media channels running. For most of the time, we have no idea what is happening outside. If there is a war, we will come to know after 3:30 or because we get a personal mobile phones and someone will send us a WhatsApp, oh, some war happened. Because that is the amount of noise that we have cut it off. Okay. So for example, I do recollect in Russia-Ukraine war. The markets came down for hopefully a week period. And everywhere, I think everyone was quite panicking about Russia-Ukraine. I'm sure most of the people would have, booked profits. But the way we think in such period, I think you should not act. You should do some work on that entire event, make full analysis of it, and then act. By just acting quickly is not going to solve the purpose as such. Because the following week, when the earnings was quite strong and the markets went up, the narrative was that, hey, earnings were so strong in spite of the war, and hence one should invest. So imagine a particular person only focusing on that noise and selling just because he saw a war news, and then coming back at a higher level to buy because of higher earnings growth is not going to make significant money in Indian equity markets.
But that, unfortunately, is the sort of
the reality.
The profile of a typical investor. You read that Russia-Ukraine headline, you hit the sell button, you panic, you say, "What's going on? My portfolio is going to the dogs." What does your team do in order to improvise on these moments and help with these cognitive biases?
So the way we do is that, for example, let me give you a real example. When there was a Russia-Ukraine war, the first thing that we saw is how does India benefit, right? And there will be businesses and sectors where India will benefit because of supply chain distortion. There would be something where Russia was quite large from an export standpoint. And if I find a company who is going to benefit because Russia will have sanctions on themselves, then I will look at that stock for sure. Okay. Right? So that is the best way. So whenever in crisis, look for opportunities.
So typically as a fund house, you all are looking a lot more at mid caps at a time when, the large cap allocation seems to be higher. What's the thinking or the reasoning behind that?
So if you look at the mid and small space in the last 6 months, where earnings growth has been quite bad for the large cap space, we have seen maximum amount of earnings upgrade in small cap, followed by mid and then large in that order. So we do believe that earnings upgrade leads to meaningful higher returns in stock price, because obviously there is PE re-rating when there's an earnings upgrade cycle playing out for a stock. The second thing is, if you look at from 2004 till now, which is when the index was formed, mid cap has been the best performing index across duration. It's actually not small cap and not large cap, it's only mid cap, because it's actually the sweetest spot of the market right now. An average mid cap company's market cap would be closer to 40 to 50,000 crores, right? And assuming a 30 P on that, they would safely have a profit after tax of 1,500 crores, which means that they can withstand a bad cycle, or they can absorb the shock in the system. And hence we see that in a falling market, while yes, mid cap does fall more than the large cap, but they rise quite fast as well, right? If you look at in this current context, India's corporate balance sheet is the best ever in 30 years. The corporate debt to equity is lowest in 30 years right now, right? So which means that whether it's mid cap or small cap, everyone just doesn't want any leverage in the system, right? Everyone wants to raise equity and put capex, right? Because of whatever we are seeing on the NCLT side, but everyone just wants to focus on equity as such. So we do believe that mid cap is probably the best placed sector, also from the fact that when the country does very well, when the country grows at a higher rate, and when there is significant amount of flows from the retail investors or the HNI investors or the mutual fund, you will see more growth in mid cap. So just to give you a final data point on last 3 years, so 20 to 24, 4 years, Nifty has seen earnings growth of 22%. Mid cap has seen earnings growth of 38%. And small cap has seen earnings growth of 48%. So obviously the higher the growth, higher the returns.
Are there any macroeconomic headlines? I know you said for the layman to monitor GST collections, but that would worry you, or that would say now we need to have a bit of a rethink?
I would be quite worried about how US is going to act on the $2 trillion spending cut that they want to do, with Elon Musk and Vivek being at the helm of DOGE. That to me is probably a Six Sigma event to watch out for. US spending is about $6.4 trillion a year. And if you cut $2 trillion from it, it will have meaningful ramification for the world. That is, I think, the single thing to really watch out for. I think tariffs and all of them is, I think, going to benefit India in either ways. But I would be very, very watchful for the spending cut that the US does and the impact on that, on jobs, deflation, all of that.
Nothing else back home?
Nothing back home. I think within India, yes, there was a bit of slowdown that we saw in the first half, but we're seeing meaningful improvement in capex. We are seeing government accelerating their capex on rail, on NHAI, accelerating capex on roads after a lull of 6-month period. So we are seeing that intensity coming back after the state elections are pretty much over. We definitely expect that to continue. So growth will bounce back.
Given that our behavioral biases always kick in at a time of crisis or reading some headlines, how important is it to have a qualified, unbiased financial advisor?
I think for most of the newer guys, in fact, for most of the experienced guys who don't have a time to track markets on a regular basis, I would say it's imperative to have it. Because a qualified financial advisor will guide you appropriately, first on the mix of the portfolio, how to reduce the risk in the portfolio. Also, he would have a much more advantage because he interacts with fund managers like us in terms of which fund house does what strategies from time to time.
Thank you so much for joining in. It's been really useful to understand some of those key takeaways. So I think it's important to understand the points that have been highlighted, and some of the key takeaways are that every crisis is an opportunity. Block out the noise, don't get too influenced by it. It's important to monitor GST collections by and large from the macroeconomic data. Pause, realign, diversify your portfolio, look at high growth sectors, and of course, do consult a qualified financial advisor who is unbiased. What were your key takeaways? We'd love to hear in the comments section. Do subscribe to Personal Finance TV. Thanks for watching. I'll see you in the next episode.